So in case of startups, they cannot tap the public financial market. So that is the reason they have to go for alternative financing, and venture capital, private equities. These are the alternative mode of financing. Venture capital mostly invests in the highly risky business. The terms are not very standardized, but mostly venture capital enters into the business and they try to come out in very short time, maybe 2 to 3 years after mentoring the business for initial period. Private equity takes an equity stake, but modus operandi is quite similar. Equity stake in the business, the modus operandi is that, I mean, the difference is the private equity, they retain with the business a little bit longer time, but the idea is same. They buy an ownership and they try to sell their stake at a very high price. Why that high price is just because they take a high risk, because many of the projects funded by the venture capital finance or private equity, they fail. So private equity is an alternative form of private financing away from public markets, in which funds and investors directly invest in companies to or engage in buyouts of such companies. So basically this is all about taking ownership stakes in the companies. Okay. Finally, last but not the least, we'll discuss about the short-term financing. Till now, what we are discussing was long-term financing. Short-term financing is basically required for meeting the requirements of working capital. Certainly, suppose we need there is a seasonality component in working capital. Sometimes there are seasonality components in working capital. In some period of the year, the working capital requirement is high. In some period, it is low. There may be other components of working capital that may fluctuate. Certain new orders have come up unexpectedly, so there is a high requirement of the working capital. So how do I finance my short-term requirement of fund? The most common is the trade credit. It is actually quite similar to bills payable. That means I buy something, instead of paying fund, I'm getting some credit from my supplier. So sometimes they may not give me cash, but they supplies me the raw material, they supplies me the machinery, supplies me other resources that I require. So that also saves some amount of money, and in that way it is a source of fund. So that is how it's a very popular way of financing, that is using the trade credit. Commercial papers are short term, mostly 1 year maturity papers that are issued by the corporates to raise short term funds. Suddenly, if you have a very high requirement of fund for 1 year, so you can issue commercial paper as a company. Consumer credit or installment credit, these are quite similar. Sometimes you get advance from the consumer. That is mostly the idea of consumer credit or installment credit. You get advance installments from consumers, so that advance installment gives you some sort of financing. What is a bill receivable financing? When you get a bills receivable, that means you sell on credit, you get a bills receivable, and that will mature after 2 to 3 months. Now what you can do, you can take that bills receivable to your bank, and bank can discount that bills receivable to you, and in this way you can encash those bills receivable. That is what we know as bills receivable financing. That is also a very good short-term source of finance. Bank loan. Now you must have a banker as you are a business. So bank loan is unsecured bank loan, just a short-term loan can be a source of financing. There are different alternative ways. Among that, I have just picked up one which is very popular, that is inventory financing. If you have stocks in your there may be warehouse receipt financing also, that is quite similar to inventory financing. You must have stocks or warehouse receipt with you, and pledging those warehouse receipt or pledging the stocks what you have you can actually raise short-term funds. So this is a very popular way of financing for small and medium scale enterprises in Indian context. Cash credit and overdraft are quite similar. Cash credit means you have certain limit. Now whenever you require cash, you can actually draw that much amount of cash, and your interest will be calculated only on the amount drawn from the bank. So cash credit, there is a limit. Actually, suppose this is your total limit of cash credit. Now whenever your requirement was there, you have just drawn this much amount, so your interest will be charged on this amount only, not till the limit which is sanctioned to you. So that is called cash credit. Bank overdraft is also similar, only in terms of security, or in terms of security. These are two: security on the part of bank. Cash credit is bit more secured instrument on the part of bank. You should have some collateral with the bank to avail the cash credit option. But in case of bank overdraft, the requirement of collateral is not there. So this is bank overdraft is little bit an unsecured instrument on the part of the bank, but on the part of the user of that finance, cash credit and bank overdraft is quite similar. Only difference is in this case, I have to pledge something, I have to give some collateral. In bank overdraft we do not require to provide some collateral, but in both the cases, till the amount we draw, the interest will be calculated on this. So this is how we actually there are different we deal with the short-term sources of financing, and this is how we raise short-term financing. So if you have any further question on this, then please let me know through the mail ID provided at the end or the last slide. Now for this I have referred to some of the online sources as well as financial management theory and practice by P. Chandra. Thank you.